find the intrinsic value of Coca Cola. And the way we start our discounted cash flow model is we need the market cap, 192.5 billion. Okay, 192.5. And then we need the stock price, and that's 44.88. So they have 4.3 billion shares outstanding. So when we calculate the future free cash flow, we have to discount it back using the WACC, and then divide that number by 4.3 billion to find out the estimated stock price and see if it's a buy or not. And this is the best way to analyze a company is look at their free cash flow, estimate it out, and discount it back. Because the cash flow is the lifeblood of the company. When you look at earnings or net income, it's not always as accurate because there can be accounting things going on, like depreciation or amortization. But cash flow is the best indicator. Now let's grab the net income for the past 4 years. My spreadsheet is all set up to calculate everything. So they had a pretty big drop from 2016 to 2017. But their cash flow didn't really drop too much, which is interesting because cash flow is usually more lumpy than net income. So I would look into that if I was investing in them to see why the big drop. They could have took a big loss on something that year. Now let's look at revenue. Okay, revenue. I was just looking at the drop in 2017. It looks like a big negative on other income. You have to look into the 10K to figure out what the other represents. A lot bigger than the other years. Okay, let's drop the revenue in. And now I calculated the future cash flow. And you could look at your statistics and figure out what looks right, or if you wanted to manipulate numbers. I usually don't try to change too much unless there's an obvious difference in 1 year. Then I may, but I use averages, so it should average out. Let's find out the cost of their debt, because we have to discount it using the WACC. So first we need the cost of debt. So the interest expense they pay on a debt is 946 million. Now we need to find out how much debt they have. Short-term debt is debt due within 1 year, and that's 15 billion. So they have a good amount of short-term debt, and long-term is almost always more. That's debt due beyond 1 year. And you can always check the 10K to see when the debt's due, because that's good information. Because a lot of companies don't pay off the debt, they just get new debt to pay off the old debt. So it's a really low interest rate, 2.21%, which is good to see. But still, a time like coronavirus, when companies may be losing money or not generating as much money, may need to take on new debt. So when they roll the old debt, the new debt may be a higher interest rate if rates go up, which they're not. But you never know what could happen in the future. Now let's see their income before tax, because we have to reduce the debt by the effective tax. 10 billion. And the income tax is 1.8 billion, so it looks like a pretty low, yes, 17% tax rate. That's not too low. That's pretty good. 20 I think is around average. So even though they pay 2.21% on the debt, you have to deduct the taxes, because it's a tax write-off debt, and it's actually costing them 1.84% for debt, which is very low. Now, when you look at the cost of equity, you need a beta. That's a really low beta, 0.56. And we use a CAPM, capital asset pricing model, and the cost of equity is 6.62%, which is really low. Most companies, it's 10 to 15%. But even so, equity costs almost 3 times as much as debt. Well, actually, no, 1.84. So it costs more than 3 times as much as a debt. So why doesn't everybody just get debt and no equity? Because with debt, you have to pay interest. And if times are bad and you don't generate much money, you might not have enough interest to pay the bondholders. But the good thing about equity, you don't have to pay them anything. They lose money while you lose money, and you gain, and they gain money when you gain money. So you're in line with the equity holder. So we calculated the future free cash flow. We did a terminal value. We discounted it back to today's dollars. And if you sum up these lines, you get 253 billion, which is the estimated price of the company. And if you divide that by 4.3 billion shares, the estimated stock price is $59. And they're trading at $45. So they're trading at a slight discount, a 24% discount. So this is actually a buy according to this model. Everybody has their own models and analysis to look at. So you might not just go with one source, but it's interesting to see that the stock was trading above intrinsic. Actually, it was trading at its peak about at intrinsic value. And it's been trading pretty close to intrinsic value, a little lower. But then it dropped off a cliff like everything else in March with coronavirus. And it was trading well below intrinsic. But now it's come up, and it looks like it's come down a little bit too. So the job of you, the analyst, to decide if you want to buy this company is not only the previous financial information, you have to look at the future. Do you think Coke is going to be viable in the future? It's been around over 100 years. It's probably going to be viable. I don't think there's that much risk with Coke, but as you can tell with the low beta, but you don't know how long it might take for them to get back to where they used to be. Because it looks like 4 years ago they were at 42 billion of revenue, and they're in the 30s now. So they may drop again now, but I'm not sure how they'll be affected with coronavirus. That remains to be seen. But thanks for watching the video, and leave a comment if you want me to do a cash flow on another stock. Just let me know the ticker.